Welcome back to OC Insurance Academy. In today's lesson, you'll learn one of the most important concepts in the insurance industry, risk management. We'll explore the different types of risk and explain why insurance companies choose to insure some risks while refusing others.
Every day, people face uncertainty. No one knows exactly what tomorrow will bring. An accident, illness, disability, fire, or even the unexpected loss of life can happen at any time. The possibility that a loss may occur is called risk. Insurance exists because risk is part of everyday life. Risk management is the process of identifying, evaluating, and controlling potential losses. The goal is not to eliminate every risk. The goal is to reduce the chance of loss and minimize financial consequences. Insurance is one of the most effective tools for transferring financial risk. The first method is risk avoidance. If you never participate in a dangerous activity, you eliminate that particular risk. The second method is risk reduction. Although accidents can still happen, safety measures greatly reduce the chance of injury or loss. The third method is risk retention. This means accepting responsibility for smaller losses. The fourth method is risk transfer. This is the primary purpose of insurance. By paying premiums, individuals transfer financial risk to the insurance company. Pure risk involves only two possible outcomes. Either a loss occurs or no loss occurs. Pure risks are generally insurable. Insurance companies only insure risks. They must meet specific requirements. A risk should involve many similar exposures. The loss must be definite and measurable. It should occur by accident rather than intentionally. The premium must be affordable. And the potential loss must create financial hardship. When these conditions exist, insurers can accurately predict losses and set fair premiums. Some risks cannot be insured. Insurance does not cover intentional acts, fraud, criminal activity, gambling losses, or investment losses. If insurers covered intentional losses, people would have little incentive to prevent them. Insurance is designed to protect against accidental and unexpected events, not guaranteed or intentional losses. Here's an important licensing exam tip. If you see a question asking which type of risk is insurable, remember the answer is almost always pure risk. Let's take a look at question number 3. Which of these is a speculative risk? Remember, this involves a chance of gain or loss. That's right, investing in stocks is the correct answer. Let's take a look at question number 4. Why do insurers avoid speculative risks? That is because they involve the possibility of gain. Excellent work. Today, you learned how risk management helps individuals and businesses prepare for uncertainty. You discovered the difference between pure risk and speculative risk, and you learned why insurance companies insure accidental losses while excluding intentional or speculative ones. These principles are essential for both the state licensing exam and your future career as an insurance professional. Congratulations on completing Lesson 3. In our next lesson, we'll explore insurance contracts, the legal principles that make them enforceable, and the responsibilities of both the insurer and the policy owner. Thank you for learning with OC Insurance Academy. We'll see you in the next lesson. Welcome back to OC Insurance Academy. In today's lesson, we'll learn how insurance policies become legally binding contracts. You'll also discover the responsibilities of both the insurance company and the policy owner, along with key legal concepts that frequently appear on the state licensing exam. An insurance policy is much more than a piece of paper. It is a legal contract between the insurance company and the policy owner. In exchange for premium payments, promises to provide specific benefits if a covered loss occurs. Every insurance contract clearly defines the rights and responsibilities of both parties. Every legally enforceable insurance contract must contain 5 essential elements. First is the offer. The applicant usually makes the offer by completing and submitting an insurance application. Second is acceptance. The insurance company reviews the application and accepts the risk. Third, the applicant pays the premium and the insurer promises to provide coverage. Fourth, both parties must be legally competent to enter into a contract.
Finally, the contract must have a legal purpose and comply with all applicable laws. Insurance contracts have several unique legal characteristics. A contract of adhesion means the insurer writes the policy and the applicant either accepts or rejects it. An aleatory contract means the value exchanged between the parties may not be equal. A conditional contract requires both parties to meet certain obligations before benefits are paid.
Insurance contracts are also based on the principle of utmost good faith, requiring honesty. Most insurance policies are personal contracts, meaning they insure a specific individual rather than property alone.
The policy owner has several important responsibilities. They must provide truthful information when applying for coverage. They must disclose all material facts that could affect the insurer's decision. Premiums must be paid according to the policy terms. If important information changes, such as an address or beneficiary designation, the insurer should be notified. When filing a claim, all information must be accurate and complete. The insurance company also has important responsibilities. It must evaluate applications fairly and consistently. It must issue policies that clearly explain the coverage provided. When a covered loss occurs, the insurer must investigate the claim and pay benefits according to the policy provisions. Insurance contracts rely on utmost good faith. This means both the applicant and the insurance company must act honestly. Insurance companies must also comply with all state insurance regulations. If the applicant intentionally hides important information, the insurer may deny a claim or cancel the policy. Honesty is essential to maintaining a fair insurance system. Let's look at a real-world example. Maria applies for a health insurance policy and accurately answers every application question. She pays her premiums on time. Several months later, she requires surgery. Because she fulfilled her responsibilities and the loss is covered, the insurance company pays the claim according to the policy. This is how a properly functioning insurance contract protects both parties. Let's look at an exam tip regarding valid contracts. Which of these is not an essential element? Is it A, C, consideration, or D? The correct answer is commission. Remember this for your licensing exam. The 5 essential contract elements are offer, acceptance, consideration, competent parties. Commission is not a required element of a legal contract. Let us review what we have learned so far. What makes an insurance policy legally enforceable? That is correct. A valid legal contract is essential. Question 2. Which element requires both parties exchange something of value? Correct answer, C. This represents the consideration in a contract. Question 3. Which principle requires applicants to provide truthful information? A. Utmost good faith. C. Assignment, waiver. Correct answer, B. Question 4. Who is responsible for paying premiums? Beneficiary, C. Policy owner, D. Underwriter.
C.
Excellent work. Today, you've learned the legal foundation of insurance contracts and the responsibilities shared by both the insurer and the policy owner. These concepts are essential not only for passing your licensing exam, but also for building trust and professionalism throughout your insurance career. Congratulations on completing Lesson 4. Insurance policies are legal contracts. Every valid contract requires 5 essential elements. In our next lesson, we'll explore insurable interest, representations, warranties, concealment, and fraud. Critical legal concepts that every licensed insurance professional must understand.
Thank you for learning with OC Insurance Academy. We'll see you in the next lesson.